good morning. You're watching Market Cafe on ET Now with me, Snehi Shah, and with me is my co-anchor Shreyansi Singh. Shreyansi, wishing you a very good morning. And well, we had a breather yesterday. We had a holiday on account of Ram Navami, but the global markets were up and buzzing. So Shreyansi, take us through what happened across Wall Street. Last couple of days have been very volatile, very topsy-turvy when it comes to Wall Street. So tell us what happened yesterday when it comes to US and European markets.
Absolutely. Well, if I might add, it was buzzing definitely, but wasn't up from the looks of it. Because what you're seeing is definitely stock futures trading near the flat line, and after that session that we've had, because when you look at S&P 500 as well as Nasdaq Composite, both of these indices logged a fourth straight day of losses. Now, tech stocks struggled with the S&P 500 and the Nasdaq Composite registering their fourth consecutive losing session. Nvidia pulled both indexes lower as the artificial intelligence play dropped nearly 4%. The 30-stock Dow as well fell for its seventh session in 8. This market pullback, of course, adds to a more difficult second quarter on Wall Street. All three major indexes are lower so far in April, in stark contrast to the stronger than expected market performance seen in the first quarter. Now, the Dow, S&P 500 and the Nasdaq have also closed below the respective 50-day moving averages as well. And that's the kind of move and the broader picture that we've seen for all three of these indices. Now, earnings season also is heating up with Alaska Air Group as well as KeyCorp reporting results before the bell, followed by Netflix in the afternoon as well. So that's the picture for the Wall Street. But moving on to the European market then, and the regional stock 600 index provisionally ended just 0.2% higher, with the majority of sectors trading in the green as well. Household goods jumped 1.8%, while tech fell 2.6%. When you look at DAX and CAC, though, they were flat as well. So that's largely the handover coming in from European markets as well, Snehi. But tell us a little more about oil, because we've seen quite the slump there.
Well, absolutely. Oil has been falling for the last couple of days, and yesterday also it fell as much as 3%. So big cuts coming in when it comes to oil as well. Now, crude oil futures have fallen more than 3% as the market dismissed the risk of a wider war between Israel and Iran that could disrupt supplies. So lots of geopolitical pressures and tensions that are coming into play when it comes to the entire oil pack. And when you look at it, the WTI contract for May delivery lost $2.67. That's in fact slightly more than 3% fall coming in over there to settle around $82.69 a barrel. June Brent futures were also down $2.73 or roughly 3% over there as well to settle at 87.29. What's key to note here is Brent has fallen below that $90 per barrel mark. So this is one point to watch out for. Remember, over the course of just last week, Brent had crossed that $90 per barrel mark. So quite the run-up we did see coming over there. But well, yes, on the back of all of these geopolitical pressures, Brent has been falling, and both of these indices, WTI and Brent as well, both of them have fallen 3%. Now, even when you look at it, in terms of the geopolitical pressures coming in, everything that's happening in the Middle East have been pressuring supply of oil. Israel is unlikely to respond by hitting an oil production or export facility in Iran. This is what experts in this field are saying. This is what they're predicting, that any escalation when it comes to the geopolitical front could lead to a spike again in oil prices, but it doesn't seem like at the moment, because things are looking like they might cool down when it comes to the geopolitical front, especially between Israel and Iran. So well, we'll have to watch out for oil prices, but as Shreyansi mentioned, quite the slump that we've seen over the last couple of days, but especially yesterday, oil has fallen 3% intraday.
Absolutely, that is the handover coming in when we look at oil as well. But let's kickstart the show with some commentary coming in then. Speaking at the Washington Forum, Fed Chair Jerome Powell spoke about how they plan to tackle inflationary pressure going forward. He also signaled that rate cuts might be delayed further. Listen in to what else he had to say as well.
By many measures, our labor market has been moving into better balance over the past year. The ratio of job openings to unemployed workers was extremely elevated in 2021 and 22, has now moved back down to levels just above the pre-pandemic era. Surveys of workers and businesses indicate a normalizing labor market. So do the rates of both quits and hires. And broader wage pressures also continue to moderate, albeit gradually. So the overall picture for the labor market is one of real strength, but gradual normalization. Given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%. For one thing, we try to be very transparent and predictable given the flow of data and events. I mean, you have to move quickly sometimes, but we do realize we have a special obligation to be predictable and transparent, and that benefits us in doing that as well. Inflation, of course, declined quite significantly over the second half of last year, over the whole year, but particularly in the second half. But 12-month core PCE inflation, which is one of the most important things we look at, is estimated to have been little changed in March over February at 2.8%, and the 3- and 6-month measures of inflation are actually above that level. So we've said at the FOMC that we'll need greater confidence that inflation is moving sustainably toward 2% before it would be appropriate to ease policy. We took that cautious approach and sought that greater confidence so as not to overreact to the string of low inflation readings that we had in the second half of last year. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. That said, we think policy is well positioned to handle the risks that we face. If higher inflation does persist, we can maintain the current level of restriction for as long as needed. At the same time, we have significant space to ease should the labor market unexpectedly weaken.
Well, that's the commentary coming in from Fed Chair Jerome Powell. He says that the Fed is not going to cut rates as soon as expected, but well, we can assume and we can understand that the Fed is in the position to take care of all the struggle that they've been seeing in inflation. The policy is in place. So, well, that was the word coming in from Jerome Powell. But let's keep it with commentary coming in from FOMC and from the Fed members, because Cleveland Federal Bank President Loretta Mester, as she says that the monetary policy is in good place and the central bank should not hurry to cut rates. Although she still expects inflation will fall further, she also said that she wants to see more data to gain confidence that inflation is moving towards that Fed's 2% target as well. And if you remember last week when Mary Daly spoke about this, she also had a similar stance on this, and other FOMC members have also been maintaining their stance on this. So interesting to see what's playing out on that front, Shansi.
Absolutely. And what's also interesting separately is tech giant Google, because they're conducting a large-scale layoff impacting an unspecified number of employees in its real estate and finance departments. The restructuring involves expanding growth to cities like Bangalore, Mexico City and Dublin. This comes amid Google's latest restructuring and cost-cutting plans. On the other hand, Tesla will be laying off around 285 employees in Buffalo, New York, as part of its plans to trim 10% of its global workforce. The notice was issued under the Worker Adjustment and Retraining Notification Act, which requires employers to provide a 60-day notice before layoffs.
Well, and another big news then, US President Joe Biden has called for tripling the China tariff rate on steel and aluminum imports as he makes the rounds in the key battleground state of Pennsylvania. Biden's demand to raise the current 7.5% average tariff is an effort to make clear that his administration's recent warnings about China's trade practices are not just empty threats.
And shifting focus from US to UK then, as inflation in the country falls to its lowest level in 2.5 years in March, although the consumer prices rose by 3.2% in the year to March, down from 3.4% on a month-on-month basis. The fall in the annual rate was not as big as anticipated, although inflation is still running higher than the Bank of England's target of 2%. Economists say that the direction of the move appears to be clear at this point.
Alright, well, that's a wrap on everything important that we were tracking for you this morning when it comes to global stories. So with that, viewers, we'll slip into a very short break, but when we return, we'll take a look at how the Asian markets have opened this morning, or rather mixed moves coming over there. So we'll take you through that in detail right on the other side of this break. Hi there, welcome back. You're still watching Market Cafe on ET now. Let's take a look at how the Asian markets have opened up and rather mixed moves coming in across Asia. And this is following Wall Street's overnight losses, which saw S&P and Nasdaq falling for the fourth straight day. Now let's take a look at what's happening. Investors in Asia will also largely be keeping an eye on Australia's unemployment rate, which is one of the metrics that the country's central bank weighs when considering monetary policy. So on the back of that, Australia climbed 0.5% on open, and it's right there, not doing much, up almost 0.4% ahead of this employment reading coming out later in the day today. Moving on, let's also take a look at what Japan is up to, because Nikkei slipped almost 1% on open. It was on pace for a fourth straight day of loss. But when you take a look over there, it's made up 0.5% in gains. It's down just 0.3% as of now as we speak. Now, in contrast, one market that is doing pretty well for itself across the entire Asian pack is Kospi, because South Korea's market has rebounded from yesterday's losses, advancing 1% on open and continues to build onto those gains, 1.5% higher, almost 40-point uptick coming in for that index. Moving on, let's also take a look at what Hang Seng and Shanghai are up to. Hang Seng nominally in the red, slight negative bias coming in over there, 0.1% trading in the red. Lastly, let's also take a look at what Shanghai is doing. And Shanghai also joining Hang Seng in the red. Very flat, not much happening over there, but trading with just a slight negative bias. But shifting focus, let's talk about what happened on Tuesday. We shut shop at 22,147 on the Nifty spot basis, implied at 22,144. So, well, rather flat start indicated for us. A tempered trading session is what seems to be lying ahead of us, Shiansi, today.
Absolutely, and let's see how that pans out. But that's largely the handover coming in from the Asian markets with.
Well, hi there, welcome back. You're still watching Market Cafe on ET now. Let's talk about a stock that's going to be in focus today, and that happens to be IFL Finance, because that company has approved a rights issue of 1,272 crore rupees at 300 rupees per share. So my colleague Somit is joining in with an analysis on what should existing and new investors do. Somit, good morning. Take it away.
Well, IFL Finance had taken a board approval for a rights issue of around 1,500 crore rupees, but they have gone ahead and now announced a rights issue of 1,272 crore rupees. Now, the rights issue price has been set at 300 rupees per share, which is at a 29% discount to the current market price. However, the rights entitlement ratio is just one rights share for every 9 shares held by investors in the company as on record date, which is April 23rd, which means that the last day to buy shares of IFL Finance to be eligible to participate in the rights issue would be April 22nd. Now, the rights issue is expected to open on April 30th and will remain open till May 14, 2024. Now, if eligible for rights issue, rights entitlement will be credited, are expected to be credited on in the investor's account by April 29th, and the last day to sell the rights entitlement, that is RE, will likely be May 1st. Now, what is a rights entitlement? Rights entitlement is a temporary credit of shares. Investors can either keep this RE and subscribe to the rights issue, or else they can go ahead and sell this rights entitlement on the exchanges. Now, what should existing and old investors do if and when they get the rights entitlement? Now, assuming that for one they get one rights entitlement for every 9 shares that they hold in IFL Finance, the estimated RE price is expected to be around 122. So they can go ahead and consider selling the RE when they get credited in their account. This will be if they sell the RE, the returns that they will get would be kind of a dividend that they will be getting from IFL Finance. Now, assuming one share for every 9 shares, this would translate into a dividend per share of around 13.6 rupees, and that is higher, in fact double than what IFL Finance has given in the past. The highest dividend that IFL Finance has so far announced is just 6 rupees per share. However, if they go ahead and keep the RE, it's too much of a hassle. They will have to subscribe to the rights issue. They'll have to keep track of the date of payments, and if they forget to make the payment, then the rights entitlement will be forfeited for them. And what should new investors do? There is no trading opportunity as such in IFL Finance rights issue, given that the rights entitlement is not much in favor, given the fact that you spend a lot more to buy less number of shares, and hence the rights entitlement is not in favor, and one would incur a loss if they buy fresh shares of IFL Finance for arbitrage, keeping rights issue in mind.
Absolutely. Well, while you're with us, Somit, then tell us a little more about Jubilant Pharma, because that will be in focus as the US FDA has granted VAI status for its Roorkee unit. So how will this be benefiting the business then?
Jubilant Pharma, if you see, the US FDA has given the VAI status for earlier import alerted impacted Roorkee solid oral manufacturing facility of the company. Now, VAI status means that the plant is in an acceptable state and of compliance, and in fact the inspection has now closed for that plant. In fact, VAI status means that supplies to US would again resume from this plant, and pending ANDA approvals might also come through going forward. Now, do remember there are more than 30 ANDA approvals that are pending from this plant alone. Now, the import alert was issued by US FDA on the Roorkee facility back in July 2021, and post an import alert placed on the Roorkee facility, the generic business of Jubilant Pharma was started to bleed. That's what analysts are saying. And in most of the recent quarters, if you see, the losses on account of this generic business contributed to around 15% of the operating profit. So that was a big hit coming in to its EBITDA so far, which would now go away given the fact that VAI status has been given to this plant. Now, analysts are expecting a 25% growth because of this in the operating profits of the company in financial year 2025 as supply resumes from this facility going forward. They are also expecting the generic business to break even and turn around in FY25. Apart from this, the key catalyst now, or the key triggers to watch out for Jubilant Pharma would be how the supply resumption takes progress going forward. Apart from that, commercialization of the new sterile facility in early FY26 would be another key important event to watch out for. Debt reduction is also one of the key important to watch out event to watch out for Jubilant Pharma, and data coming in from its new drug would also something that investors should watch out for going forward when it comes to Jubilant Pharma.
Alright, Samit, thanks so much for taking us through that. Well, that was the pharma space, and particularly Jubilant Pharma were in focus. But let's shift focus to another sector. Let's talk about cement, because the entire space is going to be in focus today on the back of the price pressures that we've been seeing persisting for quite some time when it comes to this entire pack. So my colleague Ashesha, who tracks this sector closely, is here with a report on what's happening with this entire space. Ashesha, over to you.
Well, yes, cement prices have corrected nearly 10% in the last 6 months, and now if we look at the price trend over the last decade or so, cement prices are back to where they were 10 years ago. So if we look at the prices in March 2015, they were trading at about 340 rupees per bag, and cement prices now are also at the same levels at about 350 to 360 rupees per bag. Before we move on to the demand-supply dynamics in the cement industry, let's talk about how larger players have been gaining market share for the last several years. So market share of the top 5 players stood at about 40% in FY15, which rose to 50% in FY20 and is expected to rise to 55% by FY25. In fact, some analysts also expect that the market share of top 5 players is expected to rise to 70% over the next couple of years on account of aggressive capex and expansion plans that these top 5 players have been undergoing. Let's also talk about a couple of other metrics then, and the next is why smaller players are struggling, and this is on account of the capex and highly competitive intensity at which top 5 players have been working. So competition from top 5 players has been intensifying, because of which smaller players are struggling. Weak brand positioning and stretched balance sheet position of the unorganized cement market is also why smaller players continue to struggle. Next, let's move on to the demand-supply dynamics that is taking place in the cement industry. So in FY23, cement demand stood at about 595 MTPA with demand at about 398 MTPA, which means that industry capacity utilization stood at about 67%. And consistently over the years, cement demand has been underpacing cement's capacity, and this trend is expected to continue for some more years. For instance, in FY25 also, capacity is expected to outpace demand, and this is expected to continue in FY27 as well. So looking at the current positioning in the cement industry and the fact that cement capacity continues to outpace cement demand, looks like cement pricing pressure is here to stay for some more time.
Thanks, Ashesha, for that update. Well, it does look like pricing pressure is here to stay for a while, and that is all about cement trends and how they're shaping up at this point. Moving on then to an ET Now exclusive, we learned from reliable sources that the government is working on details for launching second PLI for the steel sector. Prakash Priyadarshi filed this report earlier. Take a look.
Yes, we are learning from our sources that the second PLI scheme for the steel sector is likely to be on top of the agenda for the next government. We are given to understand that the Steel Ministry has prepared key proposals for the next government for its consideration. And the second phase of the PLI scheme for the steel sector is a part of it. As you are aware that the Steel Ministry has been working on this proposal for quite some time. And now we are learning that this scheme has been included under key proposals prepared by the Steel Ministry, which would be considered by the next government during its initial 100 days. Along with that, the Finance Ministry and Steel Ministry have discussed this proposal, and there is wider consensus to launch a new PLI scheme for the steel sector. Sources are also informing that the overall financial outlay likely to be around rupees 8 to 10,000 crore under next phase of a scheme, and some key sectors like defense, automobile, railways are likely to be included under the new scheme. Along with that, the stainless steel sector is likely to be given priority under the new PLI scheme for the steel sector. As you are aware that manufacturing of a specialty steel was covered in first phase of a scheme, and the government had allocated around rupees 6,300 crore to identified 30 companies. And if you look at the beneficiaries under first phase of a scheme, that include Tata Steel, JSW, SAIL, Jindal Steel, Kalyani Steel, among others.
Well, thanks Prakash for that. Let's get a move on then. And big event happening in the FPO space today is Vodafone's FPO that will be opening today. We learned from market sources that potential institutional investors for Vodafone Idea's 18,000 crore rupee follow-on equity offer include Rajiv Jain run GQG Partners and some other key global and local asset managers. Anurag Joshi, my colleague, is joining in with all of those details. Anurag, good morning. Take it away.
So Vodafone Idea's 18,000 crore rupee follow-on public offering, which is the biggest such equity sale in the country, opens for anchor investors, and a slew of investors are lining up to invest in the offering. And our sources have told ET Now that some of these investors include Fidelity, GQG Partners, which is run by Rajiv Jain, Aditya Birla Sun Life Mutual Fund, HDFC Mutual Fund, and these are seen as possible investors in the issue. And ET Now had reported earlier that Vodafone Idea had already secured the commitments from the institutional investors for the upcoming sale, and this issue is open for the public from April 18 to 22. Now, the management had told the media that about 5,700 crore rupees of the issue will be used for the 5G rollout. And following the issue, there will be some change in the shareholdings of the key shareholders, which is the government, the Aditya Birla promoters, they have equity, and the Vodafone PLC. The government's holding is going to come down from about 33% in the company to about 24%. Aditya Birla promoters who are holding about 18%, their shareholding will come down a tad, but they will continue to hold above the key level of 15%, and Vodafone PLC's holding also reduce because of this.
All right, thanks Anurag for all of those details. But let's stay with Vodafone Idea for now. The Finance Ministry is supportive of Vodafone Idea's FPO plans, and sources tell ET Now that the Finance Ministry will also be continuing to provide policy-related support as well. Prakash Priyadarshi filed this report earlier. Take a look.
Yes, an important development coming in at the Vodafone Idea's FPO plan worth rupees 18,000 crore has full government backing. In fact, the Finance Ministry has supported the decision to go for capital investment plans. This statement is coming from the Finance Secretary himself. He spoke to us exclusively and went on saying that happy to see that the company is coming out with capital investment plans in order to solve its financial obligation and undertake expansion plan going forward. The Finance Secretary is also of the view that competition in the sector is good for the industry. Along with that, India needs multiple telecom players at this point of time, and preserving competition in the sector is something which is a major policy goal of the government. Therefore, any decision to attract more capital in the sector is something which is a very welcome move. We need to understand the fact that we are left with only two prominent and active players in the telecom sector, with Reliance Jio and Airtel, and Vodafone Idea being the distant third player is dealing with tough financial condition. Therefore, the decision to go for capital investment is something which has full support from the government. And we also need to understand the fact that the government had already announced a financial package for revival of companies like BSNL and MTNL in order to preserve the competition in the sector. And objective behind this whole idea is to provide multiple options to the consumer in order to get better service quality going forward.
All right, Prakash, thanks for that once more. Let's get a move on then and talk about yet another big news that came yesterday. And ZEEL has withdrawn its merger implementation application from the NCLT against Sony. My colleague Ankur is here with more details on this. Ankur, help us make sense of this move.
Yes, now ZEEL has decided that it will withdraw the merger application from NCLT. Now what it means that it will not pursue legal proceedings at NCLT against Sony. However, it is said that the proceedings will continue in the ongoing SIAC, that is Singapore International Arbitration Proceedings, where the case is already going on. But it means that the company wants to pursue different strategic initiatives, strategic opportunities, and it wants to create value for shareholders. All in all, it means that at the court level, the buck stops now, and any of the hope for the shareholders to revive the merger or asking court to implement the merger is now off the hook. A company has also mentioned that it will also aggressively pursue all its claim against Sony. Remember, Sony had demanded claims from the ZEEL because the implementation of the merger was not done on time. In fact, 90 million was demanded from ZEEL upon failing of the implementation of the merger. However, ZEEL had throughout maintained that they were in favor of implementation of the merger and it was not fault of theirs, and hence they are not liable to pay any of the dues. So these proceedings will continue in Singapore court, but in India at NCLT, ZEEL has decided to withdraw the application.
All right, thanks Ankur for that update on ZEEL. Moving on then, tensions between Iran and Israel have escalated, prompting India to issue a travel advisory urging caution. Summer travel plans are being impacted as airlines reroute or cancel flights. So will you be able to get a refund for the tickets if you're stuck in the middle of all of this? My colleague Bhavya Dua is here to answer this question and give us more details as well.
Just as the summer holidays are approaching and Indians are making plans to go abroad, comes the Iran-Israel conflict. Tensions between the two countries escalated last weekend and led to India issuing an advisory cautioning its citizens against travelling to the region. This doesn't just affect those who had travel plans to Israel or Iran. It also impacts those flying to Europe, for airlines across the globe have suspended or rerouted flights. Air India has temporarily halted its Tel Aviv flights, and global carriers like Lufthansa and Qantas are bypassing Iranian airspace. Insurance brokers say insurance companies have told them to temporarily halt travel insurance sales for trips to Israel or Iran. But what about those who have already purchased a policy? So if you're one of them, then let's understand how your travel claims will be treated. If you had drawn upon plans to travel to Israel or Iran before hostilities broke out and the advisory was issued, you will have to cancel your plans, which means your flight tickets as well as your hotel bookings for now. What's more is that if you were counting on your travel insurance policy to make good the loss due to cancellation, you will be disappointed. If you booked your trip post the escalation of the conflict and travel warning, it is likely that you will not be able to obtain a travel insurance policy at all. Even if you happen to buy a product with worldwide coverage where Iran and Israel are specifically excluded, there will be little relief. This is because war and warlike situations constitute a general exclusion which comes into play even if war is not declared yet. The unfortunate turn of events is particularly harsh on travelers who are already in these countries. Given the volatile situation, your insurance company will not be able to arrange flights to evacuate you, even in case of a medical emergency. As has been witnessed during the Ukraine war or COVID crisis, it is the government of India that will carry out the evacuation. What's more is that even if you've booked a flight to, say, New York and your connecting flight from Mumbai to Dubai was cancelled specifically due to the war, you cannot hope for any compensation from these insurance companies.
All right, Bhavya, thanks for taking us through that. And while we talk about air travel, Shreyanshi, surprising, weather coming in from Dubai, mass flooding in Dubai. So air travel in Dubai has also been halted. But viewers, with that, we'll slip into a very short break. We'll be right back with more stock-specific news and updates on the other side.
Welcome back. Thank you so much for staying tuned in. Well, we have Ansh joining us with the Futures and Options Roundup. Ansh, tell us a little more.
Yes, so let's start with Nifty first. As you can see in the chart as well, Nifty is actually down by around over 2.5% from this month's high. But in the previous session, it has closed at 50 DMA. So we may see some pause to consolidation around the same level. Also, the same level is 38.2% Fibo retracement if we take it from this year's low to this year's high. So we may see some consolidation happening at around this level. Whereas moving on to index options, today we have weekly option expiry for Nifty. So we may see some volatility happening today. And we are seeing strong call writing happening at around 22,200 marked by over 1 lakh contract. So we may see some strong resistance around this level. Whereas on downside, we are seeing mild put buying happening at 22,100, indicating traders expecting Nifty to fall below this level. Moving on to Nifty Bank. As you can see in the chart as well, index has actually fallen over 3% from that key resistance of 49,000 level, which we had been mentioning from quite few time. But we may see some support at around 1.3% down from here, which is also a very strong support if you can see on the upward sloping channel as well. In index options, we are seeing call writing happening at the psychological level of 48,000. So option traders not expecting Nifty Bank to go over this level. So we may see some selling pressure at around this level. Let's also see what FIs did in previous session. In index futures, they covered around 12,600 contracts of longs and they added around 8,700 contracts. So net to net, we are seeing addition of around 31,000 contracts on downside, due to which the total long position has also slipped lower from 49% to 43.7%, indicating FIIs becoming cautious in the market. Let's also have a quick view on F&O stocks as well that will be in focus. And we are seeing strong long build-up happening in HDFC, AMC, LIC, Housing Finance, and whereas if you see talk about a short build-up, then we are seeing strong short build-up happening in Infosys and Gujarat Gas. So keep an eye on the stocks.
All right, Ansh, thanks for taking us through that. But other than all of these stocks, also tell us which stocks will be potential buzzers and newsmakers in today's trading session. I believe now we have a lot of stocks to talk about since earnings season has kicked off. So take us through all of these stocks.
Yes, let's start with Vodafone news first. They have raised around 5,400 crore from anchor investor, and today 18,000 crore FPO is going to open with a price band of around 10 to 11 rupees. Apart from this, Jubilant Pharma will also be in focus as US FDA has closed inspection of Roorkee manufacturing facility. Supplies to US should resume and pending and approval may come through. Now let's talk about a few earnings as well, and let's talk about Just Dial first. They have reported strong numbers. Revenue is up by only 2%, but the net profit is up by 26% from 92 crore to around 116 crore. Also, we are seeing margin improvement from 22.6% to 26.3%. Apart from this, Angel One has also reported the numbers, and they have reported strong numbers. Revenue is up by around 28% to 1,357 crore, whereas the net profit has jumped by over 31%. Lastly, Tata Communications will be in focus. Their reported number, which are they are below the estimates. The revenue is up by merely 1%, whereas EBITDA is down by 7% to 1,056 crore. Whereas if we talk about net profit, it has jumped by over 7 times from 45 crore to 321 crore. So keep an eye on the stocks.
So we'll keep an eye on all of those counters and we'll keep an eye on them throughout the trading session today. Moving on then, ICI Lombard came up with a good set of Q4 results. The private insurer's quarterly profit rose 19% on a year-on-year basis. Let's go across to Gaurav for the earnings fine print then. Gaurav?
ICI Lombard came up with the Q4 results, and if you look at the numbers, they were actually quite strong. So talking about gross direct premium income, which is GDPI, it increased almost by 22% on a YOY basis in 4Q FY24. And if you look at FY24 data, I mean the yearly data, it was up almost more than 17.8%. If you look at profit after tax also, it was up almost by 19% on a YOY in Q4 itself. And for FY24, the entire FY24, it was up almost by 11% versus what we have seen in FY23. Now coming to combined ratio, this was actually quite of a surprise because this combined ratio stood at 103.3% now for FY24 entirely. And if you look at Q4 FY24, the combined ratio now stands at 102.2%. Now, it is quite surprising because the management had guided that they will maintain the combined ratio of 102% till FY25. And now that the management has reached this level already, we saw some kind of positive momentum coming up from the analysts as well. Now, from here on, management has also guided that we may see exit ratio of FY25 for combined ratio to be somewhere at 101.5%, which was again one of the positive key points for the results that we have seen for ICICI Lombard. Now, coming back to claims ratio, it also improved almost by 550 basis points. Now, it stands at 68.6%. Now, management has, as we discussed, that they have guided that combined ratio will remain at 102%, but we may see some kind of improvement at the exit of FY25 at 101.5%. They expect motor loss ratio to remain at 64 to 66%. Now they are expecting mid-single digit increase in private car sales. Two-wheeler segment, they are expecting 8 to 10% increase in growth, and CV sales they are expecting double-digit growth. And lastly, for health segment also they are expecting double-digit growth. And from here on, if you look at brokerages also, they have maintained their stance on the company. So for example, Investec has maintained buy rating with a target price of 1950 rupees. HSBC has also maintained buy rating with a target price of 1990 rupees. If we talk about Nuvama, they have hold rating with a target price of 1790 rupees. And lastly, we have Macquarie, where they have maintained its underperform rating with a target price of 1100 rupees because they believe that the valuation is quite at a higher level, because they believe that the PB ratio for FY25 for the company stands at 6.1%, whereas they are targeting a PB ratio of 4 times the book value, and that is why they have maintained the underperform rating. So all in all, strong set of numbers, but a mixed set of views coming up from brokerages on ICICI Lombard.
Interesting note coming in over there, Gaurav. Thanks so much for taking us through the numbers as well as what brokerages have to say for ICICI Lombard. That stock will be in focus today. But well, when we talk about the IT pack, last week TCS kicked off those earnings from the IT pack with a rather stellar set of numbers. And today also we have two major IT bellwethers, Infosys as well as Wipro, coming out with their Q4 as well as FY24 earnings. So let's go across to Anisha to understand what the street is penciling in when it comes to both of these IT majors.
But talking about the numbers that we're expecting from Infosys this time around, the range is very wide because the constant currency is expected to decline maybe anywhere between 0.7 to 1.5%, while part of the street is also expecting a positive growth of around 0.5%. But we are expecting that maybe there'll be a 0.4 to 0.5% kind of decline on constant currency. The US revenue is expected to be down 0.5%. Rupee revenue is expected to slip 0.2% because it's a seasonally weak quarter for Infosys. There is no pass-through revenue that happens this time around. The third-party software revenue is also lower and the discretionary demand hasn't picked up. That's what TCS also told us. On the margin front, there will be that 1 month impact of wage hike. So on account of that, there would be a bit of pressure, but that would be offset because last quarter there was that one-off provision that they had to take on account of that cyber security risk, etc. That won't be happening this time around. So that's why the margin of around 20.7%. Profitability is expected to be close to 6,200 crore rupees. The large deal momentum is expected to be solid, maybe a deal win pipeline of $2 to $3 billion. But most important thing to watch out for will be the FY25 guidance. Now again, the street is a bit divided, but seems to be that the consensus is around 2.5 to 5.5%. Let's see what the company delivers on account of that, with the EBIT margin guidance of 20.5 to 22.5%. And of course, the commentary will also be key. So tracking all of these things for Infosys right now. Yes, we are expecting a weak set from Wipro to come by. Remember, the guidance for the quarter was a dip of around 1.5% to a growth of 0.5%. So there was a very broad guidance given. It's expected to come at the midpoint. So a constant currency decline of 0.2 to 0.4% is what the street is expecting. The IT service revenue is expected to be flat at around $2,650 million. Ditto can be said for rupee revenue at 22,100 crore rupees. Even in terms of the profitability, we are watching out for a number of around 2,880 crore on the bottom line. for Wipro in this quarter gone by. In terms of the Q4 expectations, well, it's weak demand environment which is expected to impede growth quite a bit. There's a wage hike impact which is going to be coming in, but that might be offset on account of the one-time costs that have come in. Deal wins are likely to be a bit muted, but the big thing to watch out for will be the new CEO commentary, because that came in as a surprise a couple of weeks ago that the erstwhile CEO Thierry Delaporte stepped down for immediate effect and Mr. Bilani had taken over. So that will be important. The Q1 FY24 guidance, which Street is pegging anywhere between a decline of 1% to a growth of 1%, and commentary on headcount and senior exits in terms of the leadership is important to track.
All right, Anisha, thank you so much for the update coming in on both of those IT majors. We'll be watching out for their numbers and the reaction as well. But that's all the time that we had on this edition of Market Cafe. Thank you so much for tuning in. From me, Shriyanti Singh, as well as Snehisha and the entire team that put this show together. Don't go anywhere, because the market takes all of the action forward.
If you like this video, then like, share and subscribe to ET Now.